Now, Charu, I think from your Saxo research, you tend to have the view that Europe is going to outperform other markets. Why do you hold that view?
So Brian, yeah, I think that's a very interesting point that you brought into the discussion. I'm glad you're following Saxo's research on that. But this year, of course, was supposed to be an year where U.S. inflation kind of eases and central bank tightening pace actually, slows down. We saw that rhetoric pick up quite well in January, but of course, February has been really a mirror image. I mean, the concerns about inflation are not dying out like we just spoke about briefly, right? So US equities continue to remain under pressure because of that. And what we've been talking to clients about is obviously diversifying your portfolios. If you are a long only, US only investor, it is important to look in other places as to where you can really get the returns. And European stocks have been outperforming since the start of this year because the macro fundamentals have, really improved significantly after last year, where we were looking at a recession probably coming in Europe because of energy pressures mostly. That story has really turned around, and natural gas prices in Europe are now down 60% from the peak that we saw in December. So that's really easing the pressure on consumers. It's easing the pressure on businesses as well, and activity levels have been picking up, as we've seen from the economic data coming out of Europe being really better than expectations. Plus as well, now the China reopening story has also picked up traction faster than expected, and that benefits Europe as well, more so than it does the US, because Europe is a more prominent trade partner for China as well. So I think cyclically, it does look like European stocks can outperform US stocks this year. And even if you look at it from a structural standpoint, we've seen this massive outperformance of the growth heavy US tech stocks, particularly over the last several years since the global financial crisis, basically. We see the reversal of that trend just starting now, where the more value-oriented European indices could start to outperform in this high inflation, high interest rates era, because investments go into more productive assets, and they are mostly in Europe as compared to, like I said, the growth-heavy US indices. So there's room for some structural outperformance there as well. And from a valuation standpoint, it really makes a lot of good sense to add some European indices to your portfolios because they are still far cheaper than their US counterparts.
Now, Charu, then which sectors should we be putting our money in, given what you've just advised us in terms of diversification from a risk and geography perspective? Obviously, when we're talking about Europe, one sector has to be defense.
Yeah, absolutely. I mean, given what's going on in the geopolitics space, I think, with this 1 year anniversary of Russia's invasion of Ukraine, and now China getting involved in the picture as a mediator, but, you don't know what kind of a response that garners from the US, whether they continue to support Ukraine if China becomes the mediator or not. So geopolitical tensions remaining high, and of course, the ideal way to hedge those tensions is by adding some defense stocks in your portfolio, and European defense, certainly, like you said, because the focus in Europe, particularly on defense spending, is quite significant. So I think that will continue to help these defense stocks, outperform in the next few years. But also, I mean, if you look at German industrials, they've also been so beaten down last year, again, because of natural gas price pressure and concerns about a recession, that a turnaround there appears likely as well. The other area that we've been highlighting to our clients are the European luxury stocks as well, which is extremely interesting now because two reasons. One, China reopening, and that certainly brings a lot more demand for luxury goods as Chinese, visitors start to travel abroad, and they start to, the demand comes back really for luxury items. But secondly, also, luxury brands have this high margin business. They have pricing power. The consumers that actually buy those luxury stocks are not as much impacted by inflation as the others. So they still have that pricing power, and they can thrive better in this inflationary environment. We're also looking at outperformance in the energy and the semiconductor space, because that's where a lot of political capital is going in Europe, right? So a lot of interesting areas to look at in Europe.
Okay, so just to recap, it's defense, it's luxury goods, it's the energy sector.
Yeah, absolutely. We can add semiconductors to the list as
and
well.
Semiconductors. Thank you very much, Charu. Thanks again for coming on the show. Thanks for your insights.